Welcome back, AP Economics students. Today we're going to talk about Unit 4.1, Financial Assets. Financial sector is made up of individuals, businesses, and governments who borrow and save so they need institutions to help them in these goals. You have the financial sector, which is the network of institutions that link these borrowers and lenders. These are banks and mutual funds and pension and other financial intermediaries. An asset is anything tangible or intangible that has value. An interest rate is the amount a lender charges borrowers for borrowing money. It's the price of a loan. And interest-bearing assets are assets that earn interest over time, like a bond. Now, when it comes to personal finance and investment, this refers to the way individuals and families save or spend or budget their money. Now, this is not a personal finance class, but if you were taking one, you would learn about things like checking and savings accounts and credit cards and loans and the stock market, retirement plans, how to manage your assets. The word investment in econ will always refer to business spending on tools and machinery, however. A low interest rate will increase investment. Here's a little chart about the risks of buying assets. Liquidity means the ease in which an asset can be converted to a medium of exchange. In general, the higher the liquidity, the lower the rate of return. Bonds versus stocks. Let's say you're going to start a lemonade stand. You borrow $100 from your GMA. Now, your grandmother just bought a bond. A bond, or security, is a loan, an IOU, that represents debt that the government, business, or individual must repay to the lender. The bondholder has no ownership of the company and is paid interest. To get more money, you can sell half your company and issue shares of stock. Stocks, which are equities, represent ownership of a corporation. The stockholder is often entitled to a portion of that profit, which is paid out in what's called a dividend. The bond is issued at a specific interest rate that doesn't change throughout the life of the bond. Example, if you were to buy a 30-year U.S. Treasury bond that has a value of $1,000 and the interest rate is 5%, every year for the next 30 years, you would get $50 or 5% off that $1,000. If the interest rate falls and new bonds are being issued at 3%, then people would rather hold on to that 5% because they can make more money that way. But you can also sell your bonds before they mature. If you sold the original 5% bond, buyers would bid up the prices since they would rather have that 5%. Here's the point. Bond prices and interest rates are inversely related. Here's a little article that links the risk between stocks and bonds and a couple videos. Thank you.